deteriorating economic data and growing political uncertainty clearly weighing on the mood this morning. Investors are fearing that a global recession might be in the cards.
Recession risks are on the rise.
Risk of recession.
Real risk that we're going to see a slowdown.
This slowdown that we're witnessing in the global economy is coming quicker.
We have economic sentiment so weak.
What concerns us, I think, the most is really the incredible strength of the bonds.
The yield curve is inverted,
which in general economists consider to be a very strong recessionary signal.
And that's been an infallible indicator of a recession.
Technical recession.
Odds of a global recession have really risen.
20% probability.
25% chance
that we get a U.S. recession in the next 12 months.
If the tariffs increase, then the risk of recession goes up as well. The U.S. economy is really at kind of a crossroads.
Recession is not our base case.
I think it's unlikely that near term,
but we think it's a very realistic bear case.
Joining us around the table, Chad Morganlander of Washington Crossing Advisors, Michael Kushma of Morgan Stanley Investment Management, and Dave Mazza of Direxion, Managing Director. Michael, I want to start with you. Do you think that the bond markets are signaling that we are going to have a recession in the United States in the next 6 to 12 months?
I don't think they're signaling for sure we're going to have a recession, but certainly the probability of recession keeps increasing. And the flattening of the yield curve, I think, is reflective of that the pressures keep rising, that we need more accommodative financial conditions given the state of the global economy. But it's not a for sure thing, but the probability is going up as we're seeing the reaction in investment-grade credit spreads widening, high-yield spreads widening, equities struggling.
So, Chad, what about from your perspective? I mean, do you think that markets are now appropriately pricing in the recession risk that you're seeing in other measures of the markets right now?
Probably not. If you do see a global deceleration going below 1%, then we think that market multiples will obviously contract. As well, you'll start to see marked downgrades within the U.S. equity markets. So right now, we went from an overweight position within risk to more of a neutral rate position. We upped our gold allocation.
When?
We actually were doing that over the last month. We've been very cautious in recommending, obviously I've been talking to you all year, to be high on the quality spectrum and to be paring back a lot of the companies that have a large amount of debt.
Dave, are you seeing a lot of people making big shifts to try to immunize their assets from losses in a downturn?
We're actually not seeing that yet, which is a bit surprising to me. So all year, actually, I think investors have been sticking what's been working. And it hasn't actually been until lately is that all of the things we're talking about are maybe coming to fruition. So I'm certainly have on my radar to see exactly what investors do. The one area we are seeing investors begin to pile into is, of course, gold and gold-backed equities.